Welcome to Insights for Business Owners. And on this episode, we have Patrick Stroth, who's a national practice leader for M&A at Liberty Company Insurance Brokers. Patrick, great to have you on the show, man.
David, it's great to be here. Thanks for having me.
Awesome, man. Well, it's offline. I told you I've been looking for someone like you for a long time, and I finally found you, and this is great. I know our buy side and sell side clients really need what you have, which is really, really exciting. But let's start with one of the key things that I think you really are so unique in the insurance world, which is reps and warranties insurance. Tell us, well, maybe start with even what that is, and tell us what kind of offerings you have.
Sure. Well, in mergers and acquisitions, you've got two sides. You've got a buy side that doesn't want to get stuck holding a lemon,
Right.
and then you've got the sell side that just they want a clean exit. They're going to be open. They're going to answer the buyer's questions, but they eventually want to move on
Right.
and get as much of their money at closing and move on to the next point in their lives. And
100%.
so between the two sides, there's this financial risk out there. And so both sides are trying to limit their respective risks themselves and pass it transfer to the other side. And so
Yeah.
you've got that natural tension. What's been great is in the middle market, these are $100 million enterprise value deals and up. The insurance
Yep.
industry came up with a product called reps and warranties. And what they did is they took the purchase and sale agreement. These are the disclosures made from the seller about the company to the buyer.
Yeah.
Things like
Yeah.
we've paid our taxes, our
Right.
financial statements are accurate. Things like we don't have any lawsuits. Okay. The
Yeah.
buyer will perform due diligence, double check that, but you're never going to know everything.
Not
And
perfect.
so
Not perfect. Yeah.
yeah, and so what happens is a lot of times the buyer is going to sit there and say, well, this is all great, but I'll tell you what, we need a little bit of a hedge. So we're going to hold back 10% of your purchase price for a
Yep.
year or two,
Yeah.
just so we have some cash to throw at a problem and mitigate the damages. Which,
100%.
that's all well and good, and it sounds nice, but I mean that can be millions of dollars. And
Right.
the sellers
Sellers
are
hate
sitting
that.
there saying, you've
Yeah.
got millions of my dollars out of my control. There's no guarantee you're going to give me that money back.
Right.
I don't like this. And the buyers
No.
are just, what are we going to do? The
Right.
insurance industry came in and said, look, I'll tell you what, show us the reps, show us the diligence. For a couple bucks, we will step in. And, if there's a breach of the reps and buyer,
Yep.
you suffer financially from that breach, fine. Don't go to the seller, come to us. We will go ahead and,
Okay.
make you whole. And what that
Mm.
does is now the buyer has assurance because now they don't have to go into legal pursuit of the
Right.
seller. The seller could have run off to Vegas and a
Oh,
lot of the money's gone. Okay,
they're
so
in the
they've got
wind. In the
yes,
wind. Yeah. Yeah.
so they have a reliable source of remedy. What the sellers get, they get a clean exit. And so
Amazing.
that
Yeah.
has been over the last 11 years been a very elegant solution to the two sides to transfer that financial risk. Instead of from buyer to seller, seller to buyer, goes to an insurance company, which is
Yeah.
much deeper pockets. It's been, again, an efficient thing. So much so that, again, middle
Mm.
market, these are $100 million deals to the multi-billion-dollar deals.
Right.
Over 90% of those types of transactions have some form of reps and
Wow.
warranties insurance.
Wow.
Okay.
I did not know
The,
that. That's amazing.
yeah,
Yeah. Yeah.
and so it stood the test of time, and it stood the test of time for three reasons. Number one, they've officially transferred that risk over to an insurance company, and so the two sides can move forward. The other
Hmm.
great benefit about this is that it lowers the amount of negotiation, time, energy, and resources because the two
Right.
sides are not hammering out the agreement. There's an insurance
Right.
policy, it's collectible. The third thing
Perfect.
it's done is it's paid claims. Over the last 10 years, they're paying billions of dollars in
Wow.
losses. And they've got
Yeah.
this thing down where it's still a very profitable product. It
Yep.
moves the M&A process forward and you take out the risk. And I'll tell you, I
Love
mean,
it.
when you think about this, what's the difference between a Porsche that you buy in a dealership and a Porsche that's on a racetrack? Okay. It's not the engine, it's the
Yeah.
brakes. Better
I
brakes
like it. Yeah.
enable
Yeah. Yeah.
drivers to perform safer at higher speeds. Reps and warranties is the brakes that helps these transactions move at breakneck pace. And so they're
I
able
love
to
it.
do that. Okay.
Love
The
it.
greatest thing now for you and your audience is that this elegant, wonderful product isn't reserved for the $100 million to $1 billion deals. It is
Right.
now with a program that can come down to deals priced as low as $1 million. From $1
Wow.
million to $40 million is a particular rep and warranty policy built just for those smaller risks that have
Amazing.
quite frankly they're less complex, they're a lot safer, and
Yeah.
they deserve a much lower premium. And so that's a new product that's out there. It's called Seller Protect. It's rebranded. If you
Seller
went and
Protect.
Googled it, would be Googled under TLPE, Transaction Liability Private Enterprise. It's also now
TLP.
being rebranded as Seller Protect,
Seller
and it
Protect.
provides a policy for the parties as little as $10,000 to $25,000 per
Amazing.
million in limits. Okay. It
Amazing.
is a big variance, but it depends. If you got a $2 million deal, you're going to look at a
Yep.
smaller rate. If it's a
Yep.
$20 million deal, the rate is actually going to be smaller because you'll buy more limits in that. So it's a wonderful deal to facilitate that transfer of businesses from the owners and founders who are either looking for an exit, or owners and founders are looking to transition their company and get it to the next level. And we've learned and experienced that the skill set to get you to $1 million to $20 million in revenue, it's a different skill set that gets you up to 50 and 100 million. And
Right.
you need
Yeah.
outside
Yeah.
help. And so that's where that happens.
It's truly a game changer, and I cannot believe the pricing. I mean, I always thought this was just so far out of reach from our sub $10 million deal clients, but it's not. I mean, that's just incredible. You said something though. I want to follow up with a question. You said the insurance company likes to see some of the diligence. What do you mean by that? Yeah, are they literally
Sure.
going into the data room, or like what's the yeah?
Well, let's segregate this into two sides. Okay, the
Yep.
first one are these middle market deals. Again, let's a bright line, $50 million and up. Okay,
Sure. Yeah. Yeah. Yeah.
these types of policies are called buy side policies. They are where the buyer is the named insured. They're underwritten by the underwriters looking at the diligence that the buyer performs. Now,
Yeah.
they're not going nitty gritty into the data room necessarily. What they do though is they piggyback onto the diligence that the buyer's already performing. So they have enhanced criteria. They're going to require, in some cases, audited financials. In
Okay.
some cases, if they're not audited, a Q of E report, they would like to see that Q of E
I
report.
get it.
They're going to
Yep.
look for legal diligence, tax diligence, these types of outside diligence, research, and so forth.
Yeah.
The underwriters will look at that, and in the case that something got missed, they
Yeah.
will step in and take care of that. That whole
Wow.
process involves an underwriting fee up front,
Yep.
and then after that, they would look at, like I said, piggyback on the diligence reports that have already been collected. That
Yeah.
whole process takes 3-4 business days if it's not a rush, and they can do it. I've heard
Not bad.
extremes saying they can do it in a day.
Yeah.
That's a substantial premium cost wise to do
I
that.
would
It is
think. Yeah.
possible,
Yeah.
but
I
they
would
would
think.
do that. When you look at deals that are under 50 million, real lower middle market deals, we
Yeah.
have this new product out again, the Seller Protector
They'll
TLP.
protect. Yeah. Yeah.
It's the mirror image of a buy side policy. What they do is underwriters, instead of underwriting the buyer's diligence, they just underwrite the seller. Nobody knows that company, that target company, better than the owner and founder. So just
Right.
as with a lot of other insurance policies, they have an application. It's very intuitive. Buy side doesn't
Yep.
have an application. They have an
Yeah.
application. They look at the financial statements, the current financials. They don't have to be
Yeah.
audited.
Yep.
And because they understand the scope of, they've handled thousands and thousands of
Right.
these
They know.
lower
Yeah.
middle
Yeah.
market deals, manufacturers, business services, tech,
Right.
they know what to look for. And
Right.
with the application, that's sufficient. So they don't need an underwriting fee. They don't need a whole underwriting process. And so they're able to go ahead and say, look, we know the finite scope of the coverage within the reps. We are going to cover the reps. And let's talk about what reps are being covered, because this is a scope that
Yeah.
everybody in their best intention think they know everything about their company, and there may be
Yeah.
something lying dormant they don't know. But
Yep.
we're looking at the reps involving the financial statements.
Yep.
We're looking at tax,
Taxes.
federal,
Yep.
state, and local,
Yep. Yep.
major operations. If you're a technology company, intellectual property. The other
Hmm.
one is material contract. Okay,
Yep.
these are
Yep.
both from
Yep.
key customers, key
Yes.
suppliers,
Yep.
and key vendors. And
Yep.
if any of that thing falls through the cracks, and a lot of times, businesses are operating, and you may have a license expire, or some other agreement has expired, and
Yeah.
you're just letting sleeping dogs lie, and things just keep meandering along for years.
Hmm.
But then it comes a change of ownership, and
Right.
suddenly everything gets relooked at and reset. And a lot of times the owner and founder doesn't know that.
Yeah.
And the buyer on some of these smaller deals may not be able to get into, get granular in the research and the diligence and realize that picked up. So everybody missed it. It's an honest
Yeah.
mistake.
No.
Okay.
No. No. 100%.
Yeah.
Yeah.
That's where you want the protection.
Did you say on these like smaller deals you need audited financials, or they don't have to be audited?
You do not need
Okay. Good.
audited
Good.
financial.
Good.
We're getting QuickBook, balance sheet,
Yeah.
and income statements.
Yeah.
There are some
Because
organizations
our,
that want a Q of E, not
yeah.
necessary for us.
Okay, great. Yeah, because our deals it's never audited
Yes.
financials. Run of the mill $3 million asset purchase or whatever, or $5 million. Just nobody's
Yeah,
doing GAAP, nobody's doing
we
audited.
we
Most
understand
people
that.
though do equality of earnings reports, so we could definitely get that to you. 3 years tax returns, obviously P&L and balance sheet for 3 years. And then for us, there's only like 10 seller reps and warranties. I mean, nothing, it's kind of the standard stuff. We don't do a lot, but it is financials, taxes, litigation,
It,
material customers, material suppliers.
yeah, it's going to be and it will have situations. We had this with the pandemic, and we had a lot of covered, pardon me, claims where, we had a key supplier or a key customer
Yeah.
that went out of business, and they go out of business not long after the new buyer acquired the company.
Right.
And then all
Right.
of a sudden it's like, wait, you didn't see this coming. You didn't know that they had a financial shortfall on a
Right.
50% client. Those are the types of things that are honest things that can happen that you want to get in on.
Right.
You could have a tax authority step in and say there were some use taxes that were not paid in
Right.
this jurisdiction
Yeah.
that the seller did not know about. I mean, let's talk about the key exclusion here, both with the
Yeah.
mega rep side buy side policy and seller protect policies. If you know of something,
Of course.
it's not covered. Okay.
It's
If you
excluded.
suspect
Yeah. Yeah.
something,
Yeah.
if you're worried about it, it's like, oh, I never thought that would lead to a loss. And that's going to be a
This
problem.
doesn't cover fraud, basically.
Yeah. Well, actually, we have a way through that. And let's talk
Okay.
about fraud, because that's a real big thing. Okay. First of all, on the buy side, if the seller is committing out and out fraud, and there's a big case with JP Morgan Chase where they acquired a tech company that was
Right.
manipulating and manufacturing users. Okay.
Yeah.
That policy paid JP Morgan, if they probably had, it was a $150 million deal from what I understand.
Yeah.
They
Yeah.
probably got a $30-40 million policy. Okay.
Wow.
That policy paid out. Okay.
It
Because
paid
of
out.
fraud.
Wow, that's a great
Because,
example of this insurance. Like, as everyone knows that case, that's an incredible case.
yeah.
She made
And so,
up all those email addresses. Yeah.
yeah, and everybody thought, okay, well, there's JP Morgan Chase, they've got great, thorough diligence, they got
Yeah.
robust diligence. If there's any fraud out there, they're going to pick it up. The
Right.
problem is if you're thinking about a buy side policy, it's, oh, well, I'm not worried about fraud. Is, you know what? Diligence isn't developed and designed to find fraud. It's just here to check boxes and double check, make sure things add up. But if somebody is intentionally hiding things, you need a forensic accountant. So that it has its value there. So for a buy side policy, it's excellent. I will tell you though, fraud is very rare. Everybody knows about this one because it's so rare. It happens. What usually happens is there's an honest mistake that the seller made in preparing the information. Okay. Seller mistake is not, an honest mistake is not fraud. Now, you can have a situation where a buyer is going to, and their attorneys are going to hit the nuclear option and say, You knew this. You misrepresented
Right.
the facts. You were not
Right.
open with us. And the seller's like, hey, I answered all your questions. You didn't ask me about X, Y, and Z.
Right.
So
Right.
you can have those situations. I would say
Sure.
this. First of all, buy side policy fraud absolutely covered. It will, if it does uncover fraud as it did in this case, then they have to move on to the next situation, was
Yeah.
subrogating from the fraudsters, which is going to be tough in that case. But let's talk about smaller deals because again, not everything is buttoned down as tightly as
No.
a audited shop, okay? And the buyers may not have a sophisticated or thorough diligence either. And you've got this situation again. Something blows up and buyer said, I can't believe you didn't tell me. You should have known about this. What? Okay.
Right.
An allegation can come. Seller protect, as with D&O and other policies, is going to protect the seller. In the event there's an allegation of fraud, the policy will provide an attorney that will cover the legal cost to respond to the buyer saying, we did not commit fraud. We may come because there is this gap that we have this rep that got breached. Let's see if we can get a settlement. We will pay the settlement without admitting fraud. You've
Wow. Yeah. Yeah.
provided
Yeah.
defense, you've got remedy, and it works out. So it is built in that way. Now, if it's intentional fraud, if you buy just a seller protect, we cannot, the insurance
I get it.
industry, we cannot consciously protect our policyholders from committing fraud. Okay.
Right.
So it can't be done. On the lower middle market, the sub $50 million market,
Yeah.
you've got the seller protect. Buyers also have a separate new product called Buyer Protect, which is a fraud standalone policy. It is just fraud.
Wow.
It's a
Wow.
flat $5,000 per $1 million in limits. So
Oh,
if you get a
great.
$10 million deal, if you want to put $3-4 million in fraud coverage, 15 grand, plus tax. So
That's
it
worth
is
it.
available. Again, here's, it's better if you get the seller protect and the buyer protect
Definitely.
in combination just to fill all the gaps. That makes it as
Yep.
seamless as a buy side policy. It has the two. Keep in mind, with a fraud policy, an honest mistake by the seller is not fraud. So if you just
No.
say, yeah, I'm just
No.
going to get the less expensive, fraud policy,
No.
if there's a
It's not
breach,
fraud. Yeah.
then it's not fraud.
No.
You've got a problem. But the concept of fraud and the fear about it is one that is now an afterthought because there are wonderful ways to elegantly protect both the buyers and the sellers in those
Yeah.
cases, whether
Oh,
fraud was committed or not.
amazing. Amazing. Quick question on that. What's the sort of general deductible on those, on like seller protect and buyer protect?
Sure. Okay, so let's focus on, in context. The buy side policies, the market deductible is it goes from either 1/2 to 1% of the entire enterprise value. So if it's $100 million deal, okay,
Yeah.
you're looking at a $500,000 to $1 million deductible
Yep.
for
Cool.
indemnity
Yep.
claims. Okay, so that's a buy side. Sell side, they do the same kind of percentage. There is, for an indemnity deductible, is 1/2 of 1% of the purchase price. There are a lot of cases, in many cases, where the buyer, within the purchase agreement, the buyer is already assuming 1/2 of 1% threshold,
Oh, yeah.
like a basket.
That's our basket. That's a basket.
Okay.
Yeah.
Seller Protect indemnity sits right above that basket, so it would pay $1. If you have a tipping basket or something where the buyer says it gets over a certain level, then the seller's on it, then we are looking at 1/2 of 1%. That is
Nothing.
it.
Yeah.
Okay.
That's great.
Now let's another parallel though with sell side. Remember, I mentioned the attorney coverage.
Yeah.
The policy provides legal defense because you're never going to settle a claim dispute or a breach without having an attorney by your side to sit down with the buyers.
No.
The seller protect provides that protection. Okay, it's in there. The cost is built into the policy. Okay.
Yep.
That deductible to the seller is $20,000 for the policy term. So if there's a breach, underwrite, the process is a buyer will notify the seller of a breach. Seller forwards that notice to us, to the insurance industry. Underwriters immediately assign counsel to sit down with the buyer and the buyer's team.
Nice.
Okay.
Yep.
Counsel has 2 questions for them. Show us the breach.
Mm-hmm.
Show us your math. If it is a $1.5 million diminution of value because of a contract,
Right. How
did you get to $1.5 million?
Right.
This whole process is identical to what they do on a buy side policy. So it's very, very similar. The same underwriters are doing this. They provide that. They also have the attorney sitting in with the seller and negotiating with the buyer just to make sure all that's done. When they come up and we've got the receipts, we see the numbers, the buyer gets paid, and it happens that quickly. The insurance carrier will send the seller a bill for whatever portion of the 20,000 or the full 20,000 for the legal
Yeah.
fees, and it goes right there. So it doesn't delay the process whatsoever.
Yeah. Yeah.
And
That's
I would
great.
say this, yeah, and contrast this again with going without insurance. Okay.
Oh,
If there's a breach, okay,
yeah.
first of all, the buyer is sucking up that escrow. The seller may never see it. And if they do see it, is after a multi-year headache of fighting and getting legal representation on their own at their own expense to debate
Yeah.
that with the buyer. These disputes, regardless of large mega market or small market, you get human beings involved. You got their principals are involved, and all of a sudden they dig in, and people get very emotional, and claims get dragged out for years. Okay,
Oh, yeah.
I would say after 10 years in both the buy side and now the seller protect, 80% of the claims are settled and
Wow.
paid within
Yeah.
18 months of reporting it to the carrier. That is lightning fast. It is the
That is.
most efficient line of insurance in the entire industry because
That is.
we've got good parties on both sides. They have lots of information, and underwriters appreciate this business and will stand by their word on the product.
Yeah, no, and I think objectively, it's statistical. I mean, like all insurance, it's statistical,
Yeah.
and I'd say anecdotally for us, if think of the last 100 deals we closed in the last 2.5 years or something.
Wow.
Two.
That's a good, I'm sorry, David, that's a good number. That's a
Oh,
lot of
thank
deals.
you. Yeah,
Very
yeah.
good. Yeah.
Two went south pretty quick post
Mhm.
close. I don't know if that's that's anecdotal, but my sense is it's a couple percentage points where there's like real post
There's
close
small
problems.
risk. Yeah. Yeah.
Yeah,
It's
and,
small
and
risk.
and you look at them, that's great. I got to ask about a totally different type of policy because this is so
Sure.
crucial too. DNO tail policy.
Yes.
Explain what that is and why it's important. It's another thing I think people really need to think through carefully and
I,
consider.
I think it's essential. Now, D&O is directors and officers liability. What you do
Yeah,
is you think about it as it's business insurance for the corporate business entity. If you're a
nice.
manufacturer or a service provider, your real liability is making your goods and making sure that your goods behave appropriately or do
Yeah,
what they're designed to do. If you are
yeah.
a professional service, you're ending a contract with a party in exchange for money to perform some services, and those are your
Mhm.
key things. And so, as there are insurance policies for those activities, but not for the overall global or governance type activities that happen. And so, a lot of people default and think, we're not publicly traded. We don't
Right.
have outside shareholders. We don't have a board of directors. It's just me and my spouse own this company, so
Yeah, right,
there's
right.
nothing to it. We don't need it. Okay. Well, a business uh, governance operation or an activity would be selling your company to somebody else. That
Yeah,
is an activity that happens. And so a lot of people who have gone on privately held company don't have
yeah.
any of this protection because they, quite frankly, didn't think they needed it. Well,
No.
then it comes to this transition, okay, and there's a
Yep.
major liquidity event that comes in.
Yeah.
Now, buyers who are acquiring, particularly a stock deal, but also it can happen in assets, but buyers are consistently requiring the owner the founder owner to secure a D&O tail policy.
Mm.
The reason why is because once that transaction closes, okay,
Yeah.
going forward, the buyer is the deep pockets. They have
Right.
they've got the assets of the company, they're everything going. And what happens is that the fear is that there's some wrongful act,
Yep.
unbeknownst to anybody, that happened prior to close that
Right.
nobody knew about.
Yeah.
Okay.
Yeah.
And
Yeah.
what the buyers don't want, what they do want is they want insulation. They want protection from
Yeah.
any skeletons coming out of the closet after
Yeah.
closing that will go ahead and they're going to come after a buyer, the deep pockets. And this happens
Right.
when you've got liquidity. Now, where are these going to come from? They could come from former clients. They
Yep.
can come from prospective other suitors. You could have, just because you agreed to sell your company to one firm,
Hmm.
maybe there's some other someone who's left at the altar that thought, wait a minute, you owed me. I had the shot. I had a better deal. You could have those types of disputes and disagreements. And these are all
Yeah.
legal business things that come in. They come under the scope of a D&O policy. What
Yep.
underwriters do is we look at this and we say, okay, owner, as of today, as of closing, okay,
Mm.
do you know of anything that could come up?
Right.
Former
We
employee,
ask that. Yeah, we always
issues,
ask that. Yeah, they say no.
anything
Yeah,
out
yeah,
there?
yeah.
No, I'm
Right.
signing off now. I don't. They're already making this warranty statement to
Yep.
the buyer. Okay, we don't know of anything. We've checked and everything. The buyer's done a background check,
Yep.
a title check, things like that. Okay, I don't know of anything. Well, underwriters are going to look and say, well, if you don't know of anything, we agree for a couple bucks that we're going to protect you from that close time all the way back in time until your original incorporation date. You are
Wow.
protected so that if in the next 6 years, the other way,
6 years.
the 6 years,
Wow.
if anything comes out of the woodwork, we will stand by you and protect you. And what the buyer does is say, good, because once you are protected with that policy, if somebody comes after me, I'm just going to point them to that policy.
Yeah,
The
yeah.
buyer's got to get coverage going forward. But this
Right.
is a way to get
This
any of the
is
legacy issues out. Okay. And most D&O insurers do not want to do this. They
I
want
wouldn't
to
think.
collect the premium for 3, 4, 5 years ahead of time, and then what happens
Right.
is they will offer a tail later. But then they've got the track record; they feel good. Okay, there are other carriers that appreciate that there really is not much exposure, and they
Right.
are willing to go ahead and do that. Now, why 6 years? They pick that number out of the year.
Yeah.
It's the statute of limitations. After
Max
6 years, you
statute of
can't bring a
limitations.
claim
Yeah.
against it. So the lawyers and the buyer are going to insist on a 6 year tail. There are some D&O policies that will only give you a 3 year tail.
Makes
I
sense.
don't know why, but they do. That's why you want to come to a firm like Liberty Company, because we can get you 6 year tails.
6 years.
We will get it for the D&O, the employment practices, so that if we've got any legacy, discrimination, unfair treatment, harassment, things that all of a sudden are bubbling up because, again, we got a liquidity event. That's the big catalyst that's out there. That policy can step in, and also fiduciary liability if you set up an ESOP or a 401k plan.
Mm.
401k plan may have not been administered great. Well, you don't
Right.
find out until post closing, and
No.
then people are trying to roll over, and there's a problem. They want
Right.
the fiduciary. Those are the types of things that are covered.
Let me ask about this because it's sort of like it's connected to the indemnification,
Mhm.
provisions that we always put in there. But in all honesty, when I explain indemnification to clients, they're like, "Yeah, this doesn't sound great," and I'm like, it's not actually great. So this is in some ways indemnification, right? Sort of like,
Well, that's exactly what this is. This policy, both the reps and warranties policy and a D&O tail, are intended to step in the shoes of the seller with regard to indemnification. The only
yeah,
exposure the seller is going to have, indemnification is a fancy way of saying you got to pay the other guy.
right,
This is the amount you
right,
got to reimburse them for their loss. So when the
yeah,
buyer comes back and says, because of whatever you did, I'm out $2 million.
right,
And here's the thing: under the purchase and sale agreement, under that indemnification provision, hey, seller, you can't avoid this.
right.
You're facing, because you have a contractual obligation that you got to pay that money.
Right.
Whether you have it or not, that's not their
Well,
care,
that's
because it's there.
and this is great because and I always counsel clients, and I was like, okay, you've got indemnification because they're like, oh, I'm solid now. I'm like,
Yeah,
well, no, because how do you enforce an indemnification clause in a purchase agreement? If they don't want to do it, you sue them, right? So
yeah,
now you're suing the seller to get them to indemnify you. Not a great option.
yeah.
Oh,
And
seller,
this
you just
is
got to
elegant.
defend me.
Yeah,
You know,
this
this is
this is an
elegant. You
elegant
just
way to
go
get through
file
it.
the claim. File the claim. What does this cost? What's kind of
What's nice is the D&O rates have come down. I would say on a deal that's under, let's say, $30 million in
yeah,
purchase
yeah,
price. Okay.
yeah,
Um, A $1 million D&O limit policy is going to run about $18,000. A $2 million will be about 25,000.
Oh
I
wow!
would
So it doesn't
always
cost that too much more to just
no,
say
it
two
does cost. It
million.
won't be 36.
Yeah.
I would say this though for a D&O policy. I say this on the Seller Protect as well as the insurance policies. You need to think about, that's your bank account. You're not getting anything outside of that. So
Right.
if you have a policy that is covering legal expenses, you want
Yeah.
at least $1 million buffer
Yeah.
just to cover legal expenses. Now I'm
I
based
know.
in California. You've got
Right.
states like New York and
Yeah.
of all places, Texas. Everybody thinks Texas is this red state and there's no sales
Right.
tax and everything.
Yeah.
Their legal expenses are huge, and
Crazy.
judges are not open to settling things quickly. Things drag on very
They
long.
drag
And
on.
so,
Yeah. Yeah.
what you do not want is you do not want a situation where you've got a dispute. There's a settlement on the table for $500,000. Give us $500,000. We're going to walk away. And you go to
Yeah.
your insurance policy. It's like, okay, is against my wishes, but let's close this. I want to move on with my life.
Yeah.
And it's like,
Yeah.
well, you only had $1 million policy. We use 800,000 in legal expenses.
On legal.
So
Right,
your
right.
minimum in this day and age, a million. Think of it, $1 million doesn't go very far. Okay,
No.
get a $2 million limit. It's going to cost about 25 grand. Okay, on the Seller
Not bad.
Protect, yeah, we would recommend at least we like 50% of the purchase price is a
Mark.
great mark.
Yeah.
If less than that, understood, but not less than $2 million. But the
Makes
rate
sense.
the rate is a little bit more favorable when you add more limits. And as you get to the buy side, what's happening now? These very sophisticated, huge buyers, $200 million deal. They would look and say,
Yeah.
well, let's see, we've got a $20 million escrow if we do a 10%. Okay,
Yeah.
just get a $20 million policy. The policy will replace the escrow. Well, that's all well and good. But what if the
Right.
loss is $40,000? Well, we got 20 million. I mean, that's half of it. Okay.
Yeah.
We are seeing buyers in the wake of the JP Morgan chase loss. They probably, like I said, it was a $150 million deal. They probably got 15 million in limits and all. Okay.
And they lost 100 something.
And they lost substantially more. So we would always look, and there are options. You could always take a look at the cost. And a lot of times the cost between one level and another level is so negligible. Just,
Right.
Get it,
Just do
forget it. I mean, the purpose of these products is to remove these constraints, get the handcuffs off so that you get a clean exit. And if you're a buyer, you can move on freely knowing that, if there's remedy, we've got a funded policy to protect you. Okay.
Right.
And it just moves forward and then life goes on.
Let me ask one and final question. Can these costs be paid at closing? Like, are these, or do you buy the policies like upfront? Yeah.
No, that's exactly, no, these are paid at closing. Okay.
Great.
And so I would check, I can't confirm it, but it should be a deductible expense, transaction expense. So I think there's one benefit for you right there. These premiums are not due until the deal closes.
Perfect.
If the deal, and if you reach out to me and I'd sit down with you, talk about if you're signing on one day and you're closing at a later date, we would order the policy at signing. You don't pay till closing. And
Perfect.
so you can at least get it locked in. On buy-side policies, same thing. Those premiums are paid at closing. Amazing. The caveat is the buy-side has an underwriting process. There is an underwriting fee that's paid up front. You pay the underwriting fee, then you move forward. Okay,
yeah,
so you don't.
That's fine. That's fair.
You don't secure multiple quotes and then pay for multiple quotes. You just figure who you're going to go with, move that way.
Yeah.
But again, that's great. And there are no installments or anything. It's one time paid, covered for 6 years. The policy terms, these are all these policies. D&O tail 6 years. The rep and warranty policies, they run as long as each respective rep runs.
Yeah.
So if a rep is 12 months, it's covered for 12 months. You don't have to cover it anymore. If it's 6 years, fundamental reps, tax reps, those are 6 years, no additional costs. They're all the same. The policies are built to mirror the terms of the purchase agreement. So we don't have gaps. We match the agreement.
That's awesome. Patrick, this is so insightful. I love what you're doing. This is a game changer. I cannot wait for our clients to find out about this and our listeners. What is the best way for people to find you?
Yeah, David, the best way to get me is reach out to me directly. It's My email address is first initial P and then
Yep.
Stroth, Stroth
Yep.
at libertycompany.com. So it's Liberty Company,
So
all
easy.
spelled out, not Liberty Mutual, but
Awesome.
Stroth at libertycompany.com.
Awesome.
Shoot me your email address.
Yep.
And if you were to tell me I need 3 data points for either your company or for your
Yep.
target, okay, tell me what type of industry,
Yep.
class of industry the business is in, what's
Yep.
the purchase price, and what state you're domiciled in. With that information, we have enough for a ballpark indication. We will
Wow.
send you an application if you need the D&O tail. I get called by attorneys all the time within days of closing, needing a tail. The turnaround time on these sub $50 million deals and D&O tail policies is 2 business days, sometimes
Amazing.
sooner, but it's 2 business days and we can get that. But it's pstroth at libertycompany.com, all spelled out. If not, you can go ahead and look up Liberty Company's website, but it's a lot easier just getting my email address.
Just
I will get back to you same day.
Awesome. Patrick, thank you so much for coming on. I've learned so much. Really appreciate what you're doing.
David, it's a pleasure, and I'm looking forward to working with you and your colleagues. You guys take care, and let's get those deals closed.
I love it.